This is the United Kingdom, a global financial powerhouse, a nation steeped in history, a G7 economy. But behind the facade of Big Ben and the bustling city of London, a colossal figure looms, a debt mountain of £2.7 trillion. That's almost £40,000 for every single person in the country. This isn't just a number on a spreadsheet, it's a ticking clock, a historic burden not seen since the rubble of the early 1960s, hovering near an eye-watering 100% of the entire country's annual economic output. For years, the question has been whispered, can Britain manage this? But now, as the numbers climb and the global economy shudders, a more terrifying question emerges. What happens when this $2.7 trillion debt load finally snaps? To understand how Britain found itself teetering on this fiscal cliff edge, we need to look at how this mountain of debt was built. The recent surge is undeniable. Extraordinary spending during the COVID-19 pandemic, furlough schemes, NHS funding, blew a 15% hole in the GDP in 2020 to 2021, a peacetime record. Debt ballooned from £1.8 trillion to over £2.2 trillion almost overnight. Then came the energy crisis, the cost of living payments, and the infamous Liz Truss mini-budget in September 2022. Though short-lived, that episode was a stark warning, a glimpse into how quickly market confidence can evaporate, sending borrowing costs spiraling. Gilt yields spiked, the pound plummeted, and the Bank of England had to step in. It didn't add much to the debt directly, as measures were reversed, but it was a brutal lesson in fiscal credibility. Today, that £2.7 trillion figure represents a public sector net debt of around 96% of GDP. While forecasts suggest a slight stabilization, even a modest dip to around 95.9% by 2024 to 2025, the sheer scale remains. And servicing this debt? That's where the real pain begins. In the 2023 to 2024 fiscal year, the government spent a staggering £107 billion on net debt interest. That's nearly 4% of GDP, a jaw-dropping 8.7% of total public spending. To put that in context, that's almost £1 out of every 10 the government collects in revenue, nearly as much as the entire school's budget. This isn't money for hospitals, schools, or roads. It's the price of past borrowing, a heavy chain on future prosperity, fueled by higher inflation and interest rates hitting the UK's inflation-indexed government bonds. The government, like any household, has income and expenses, but for years the UK has been living beyond its means. Public sector receipts, mostly from taxes, reached around £1.1 trillion in 2023 to 2024, roughly 40% of GDP, the highest tax burden in decades, driven by tax rises and fiscal drag. Income tax, national insurance, and VAT make up the lion's share. But spending consistently outstrips this. Total public spending in 2023 to 2024 was about £1.23 trillion, or 45% of GDP. The biggest slices of the pie? Social protection, pensions and welfare, at around £361 billion. Healthcare, the much-loved NHS, consumed £221 billion. Education took £112 billion. And then there's that ever-growing slice for debt interest. The result? Persistent budget deficits. In 2023/24, the deficit was £131 billion, or 4.8% of GDP. While down from the pandemic peak of 15%, it's still above historical averages. And these deficits aren't just for grand investments. The current budget deficit, borrowing for day-to-day spending, consistently exceeds forecasts, indicating ongoing challenges in fiscal management. The Office for Budget Responsibility, the UK's fiscal watchdog, often finds its forecasts looking optimistic in hindsight as actual borrowing creeps higher. So is this £2.7 trillion debt sustainable, or are the warning lights flashing red? Credit rating agencies still give the UK strong investment grade ratings. AA from S&P, AEA 3 from Moody's. They believe Britain will meet its obligations for now. After the 2022 mini-budget chaos, Moody's restored the outlook to stable, citing restored policy predictability. But they flag elevated debt and low growth as serious challenges. Market interest rates on UK government bonds, or gilts, tell a more nervous story. After years of ultra-low rates, 10-year gilt yields have surged, hovering around 4.5% to 4.8% in 2024, levels not seen since before the 2008 financial crisis. Higher yields mean higher borrowing costs for new debt and refinancing old debt. Every 1 percentage point increase in gilt yields could add £12 billion a year to interest costs in the long run. The public sector's balance sheet is also deteriorating. Net worth, the difference between assets and liabilities, has worsened, with the deficit in public sector net worth, excluding public sector banks, growing by over £100 billion in a single year. These are not signs of a healthy fiscal position. Beyond the immediate numbers, deeper structural cracks threaten to undermine any attempt at stability. First, an aging population. The old age dependency ratio is climbing. More retirees means soaring costs for state pensions. Already over 5% of GDP and rising, thanks to the triple lock in an immense pressure on healthcare and social care. The OBR warns that age-related spending alone will push debt higher in the 2030s without serious reform. Then there's the NHS. Healthcare spending is already around 10 to 12% of GDP. An older population and costly new treatments mean this will only grow, squeezing other public services or demanding yet higher taxes. Compounding this is Britain's lost decade, or rather decade and a half, of stagnant productivity. Since 2008, productivity growth has been dismal, averaging around 0.5% annually compared to 2% before. If the economy doesn't grow, if Britain doesn't get richer, the debt burden becomes heavier, and the capacity to service it shrinks. And with the tax burden already at a 70-year high, how much more can be squeezed from taxpayers? And let's not forget inflation. A significant chunk of UK debt is index-linked, meaning interest payments rise with inflation. The recent inflationary surge directly translated into higher debt servicing costs, a stark reminder of this vulnerability. The current government's mantra is fiscal discipline. After the trust debacle, the strategy shifted to stabilizing debt, primarily through tax increases, like freezing income tax thresholds, a stealth tax dragging more people into higher bands, and tight controls on departmental spending. The aim is to get debt falling as a share of GDP by the end of a 5-year forecast period. But this leaves precious little wiggle room. The OBR's forecasts often show these fiscal rules being met by the slimmest of margins, vulnerable to the slightest economic headwind. Public services outside protected areas like health and schools are facing real terms cuts. And what about the public? Polls show Britons are worried about the £2.7 trillion debt. But there's little appetite for traditional austerity. When asked, most prefer taxes on the wealthy or corporations over cuts to public services. This creates a political tightrope: how to control the debt without alienating an electorate weary of squeezed living standards. So can Britain sustain its £2.7 trillion debt without breaking? The answer for now is a precarious yes. The UK is not on the verge of an immediate Greece-style collapse. It borrows in its own currency, has a long debt maturity profile, and benefits from the Bank of England's presence in deep capital markets. Investor appetite for gilts, though demanding higher yields, remains. But the equilibrium is fragile, dangerously so. The debt is being managed, but at the cost of a high tax burden and strained public services. The current path isn't decisively downward. It's more like walking a narrow ledge, hoping not to stumble. What could make it snap? A global recession hitting tax revenues, a sustained period of much higher global interest rates, a further hit to UK growth, a geopolitical shock, or simply a loss of market confidence, a belief that the UK can no longer manage its affairs, a repeat of September 2022, but on a larger, more unstoppable scale. If it does snap, the consequences are grim. Severe austerity far beyond what we've seen, a sterling crisis, soaring inflation, a desperate plea for an IMF bailout, the unraveling of public services, the social fabric torn. Britain's £2.7 trillion debt isn't just an economic statistic, it's a measure of the nation's vulnerability. The path to genuine fiscal health requires more than just hoping for the best. It demands sustained economic growth, difficult choices on spending and taxation, and a rebuilding of fiscal buffers. Without these, the UK will continue to walk this treacherous tightrope, with the abyss of a debt crisis yawning ever wider below. The question isn't just if it can sustain the debt, but for how much longer, and at what ultimate cost to its people and its future.